Hey, welcome in to the show. It's a beautiful, what day is it, Paul? Wednesday? It's a beautiful, is it Wednesday?
Tuesday.
Is it Tuesday already?
It is Tuesday.
Good morning, everyone. We welcome you in. This is strange, Paul. You and I, no Mo, in a quiet, eerie studio, just by ourselves, you and me. What are you doing over there?
Just answering some emails.
Perfect. We're so happy you joined us. Welcome to the show where Paul texts people and answers emails live on the air. Let's cut to it, Paul.
Well, I have to. My brother just wrote me an email.
You're a very busy and handsome man.
Well, thank you. I have to answer my brother's emails because he's the boss now. And he doesn't give me my pay unless I answer his emails.
Well, that's true. You have to divvy up dad's money.
Yeah, exactly. I want my share.
We welcome you in to the big show. This is really our 2 p.m. show. We're doing at 10. Paul, we floated around the idea of at some point in the future, all of us doing a morning show sort of with Mo. Because he just slays in the morning. Obviously, we catch Europeans and people all over the world a little earlier than the 2 p.m. show. So hope if you guys like this, let us know, and we'll get cracking. Obviously, folks, we have some news to go over. We will certainly, if you're a huge Everything Money fan and been with us for a while, you will certainly see the comments blowing up with some people who aren't our fans of late.
Guys, and by the way, be nice to them. I don't want to create this fiasco of this West Side Story, when you're a jet. I mean, it's just, listen, everybody has their analysis that they do. The one thing I will say though, and I'll repeat over and over, if you are doing research and reading a 10K and reading news before you're looking at financials, you are wasting your time. Absolutely. Every great investor I know screens out with financials first and then goes and says, these are the 100 companies, 200 companies that fit my financials. Now let me go do more due diligence and see which ones I want to own. That's the only thing I'm going to say about everyone's criticism about that. You're literally wasting your time. To me, that's literally like proposing to somebody and then saying, okay, now I'm going to figure out if I actually like them or not. I won't get married. I won't buy the stock, but I'm going to propose first. Then when they say yes, I will then go, okay, let me go start. No, let me first find out if I like them. Let me first find out if the numbers even make sense first. And then I'll go and say, okay, what other things do I want to do? So that's the only thing I'll say. I don't want to get in this whole, everybody's asking me, Paul, you react to Jeremy? I'm not going to react to Jeremy. One of the great things about having this channel, a year ago, I'd have been pissed. Now I'm like, whatever, have your opinion. Great, more power to you. I don't care. Just move on.
Yeah, I mean, it takes a lot of experience to be in your position, Paul, where you've seen the ups and downs of a market. You've seen people who talk like this come and go.
It's playing out like the last two big crashes we've had in stocks and real estate. Literally, I was told in 06 and 07, you are stupid for not buying real estate. And when prices collapse in 09 and 10, you are stupid for buying real estate.
Yes, you
in
imbecile.
09, when the crash happened in stocks, why the heck are you buying stocks? In 2000, this plays out every single time. The characters are different. This time it's EV and these other hype companies, but it's always the same thing. I mean, real estate, same thing. Paul, you're stupid for not buying real estate deals now. Well, why? I don't think your assumptions are accurate. That's all the bubble is, by the way. All the bubble is making unreasonable assumptions. We can all make every investment look great based on our assumptions. A bubble comes when there's too much over-assumption. Now, the same thing happens on the flip side. In 09 and 10, literally banks would not lend to us money on real estate. Why? Because real estate's going to the crapper. You're not going to get any real estate value growth. I bought a property in 2009, a big property, 280 units for $10,800 per door. We are literally doing our final renovation.
Go on.
It will be appraising for $85,000 per door.
Come on.
Yeah. And we're going to be into it for like $30,000 a door. I look at this going, wait a second. I look at this going, I bought when everybody hated real estate. I made a lot of money. When you buy when everybody loves something, and I'm not saying it I bought a great property in 2000, actually our best property ever in 2015, which was the middle of the real estate. But I'm just sitting there saying, don't get caught up in the hype. When hype is high, when you have average people being geniuses, everybody's a genius in investments, you should be the most scared. That's when you should be fearful. If you don't agree with me, I get it. But I guarantee you, and sometime in the next 5 or 10 years, you're going to look back and go, I really effing hate that guy, but maybe he had a point. You'll never verbalize it, but you'll say, maybe he had a point. Okay. Just like Amazon. I look at Amazon going, man, I really was wrong on Amazon. Like completely wrong on Amazon. Mm-hmm. That's the only one I can think of right now going, oh my God, because the reason I was wrong on Amazon was not just because it went up high. I didn't understand I didn't value the stickiness of Amazon as much as I should have.
Well, it could have not stuck like.
Yeah, but I think there were indications back then when I was still anti-Amazon stock. There were still indications that the stickiness was there. I was using it like crazy. But I sat there and said, I went purely based on the numbers only, saying, and by the way, my numbers were based on revenue assumptions that I didn't think were possible. I remember saying, guys, for you to justify this price, you got to be the size of Walmart. Well, guess what? They're the size of Walmart now, right? So I was like, okay, I didn't understand that. But even then, I'm still okay with that.
Yeah, so if you're looking for a Jeremy from Financial Education reaction video, you're probably not going to get it because Paul did not watch the video. I leafed through it a bit. I'm a little more.
By the way, Seth, I'm going to call you out right now.
Let me say my piece real quick, Paul, before you get into that. I would say this is, and Paul did not watch the video, but he said in general, it's like most people think they're right. He thinks he's right. We think obviously we're right. We're at least trying to model what we do around some very famous investors. And again, folks, if you're a follower of ours, a lot of this will make sense. If you read the book Richer, Wiser, Happier, you'll read about a lot of people in this world who've been doing it really great for a long time, and they all sound a lot like Paul.
I sound a lot like them.
Vice versa, just the way they are, the way they act and think, their mindset. And so in the end, what my take from the video was that we just have a different opinion of what fundamentals are. Apparently, Paul, for us, looking at the past as a model for predicting the future is the definition of our fundamentals. And it seemed like Jeremy's fundamentals were what the company is going to do. And you have.
Oh, I believe in what the company is going to do, but I base mine on history of the company and pricing, and what you buy, what you pay is what you value is what you get, price is what you pay.
Yeah.
Right? And that's the difference. And it's like, okay, will they be right? Will all the hypesters be right in a few? Absolutely. Amazon, if you bought Amazon in 2000, you saw it go from 113 down to 6, and then back up and now it's at 3,300 or whatever it is. So it can work out. But if you look at the collective whole, it's just a hard thing. And, when you say something, Seth, I'm not trying to clone anyone. It just, when I started getting my ideas, I've read more about value investing in the last 3 years than I did before I became a value investor. But then when I became a value investor, it just happened where I thought this makes sense, this makes sense, and I'd see things and people were like, "Oh, you copied that from me." I'm like, "I swear, I never even heard that." It's just that we all sound alike. Mm-hmm. And speaking of sounding alike, could you please follow us on Instagram? At Paul Gabriel, at TraderMo_EM, and at Seth Kuchanan. You write like a child. This is incredible.
I was very careful there because it's a kooky last name.
It is a kooky last name. But if you just type Seth Kira Cha and you'll find it.
That's me.
We're not, the great thing about value investing is when a stock goes down and you still believe in it, you have a reason to buy more. The problem with hype investing is when the stock goes down, you're out.
Well, I was watching other videos on Tattooed Chef prior to seeing it. And I think the transitional piece, Paul, is what I'm finding is when people fall in love with the growth of a company, they're not doing exactly what you just said. The idea of what to pay, we've always sort of joked around in the past, like just pay anything, right? I mean,
that's what you're saying that's what you're saying when as a stock goes up, because as you've always seen, okay, how about 10 times? That's ridiculous. And then all of a sudden it goes up 10 times and you have a new slew of investors who say, okay, now it's fairly priced right now. What about 10 times that? No, it's not worth that. It goes up 10 times. Then you have a new slew of investors who just get on board saying, okay, this is fine.
That's what I'm seeing too. It's like I watch a Tattooed Chef video and they say, man, anything under 17 is a deal. And I'm just thinking, they never say why this price. It used to be said price. Now it's lower. That's a deal. And that's a very common thing. I had dinner last week with somebody who said, well, yeah, I could see a 25% drop in stocks, but I don't think it's going to happen. No conversation about, well, what should stocks be worth overall? Let's talk about that. Like look at the NASDAQ. I remember when the NASDAQ at 5,100 in 2000, it got as low as 1,100 or 1,000. But when it was at 3,000, people were like, well, okay, it's already dropped 40%. It's not going to go further. It jumped another 66% from there. Because at the end of the day, what matters is the value. If it were so easy as to say, fine, come buy my house for $100 million. You know what? I'll discount it to $20 million. It's an 80% drop. Does that make it worth $20 million? Yeah, great deal.
What was that?
It's a great deal, yeah.
I mean, it should be a great deal, but no, that's not the way it works. If it's still not worth $20 million, it's still overpriced. I don't care what you drop the price to. And that's a very common, when people talk about, that's why I always tell people I don't like negotiating. Because to me, negotiation's about, well, let me start here and I'll work my way down because they feel like they're getting a good deal. To me, it's like, no, if it's worth this, I'm not negotiating. Let's not even get in the conversation. And that's the way I look at everything the Mr. Market analogy, right? I'm not negotiating with Mr. Market. He's just telling me take it or leave it. And I can choose to buy or not buy. That's it. And I'm choosing not to buy. There are some stocks I've chosen to buy. Look at Alibaba. What is Alibaba at now? Is it true it's at 170 right now? By the way, look at this. I've bought a lot of Alibaba. I haven't even looked at the price. I don't even care what the price is right now. And somebody said to me today it's at 170. Is that true?
I'm pretty sure. I mean, some in the comments, folks, let us know. I just had our software up, Paul, and I was looking at a different company. But yeah, 170. Didn't we say that, Tim? 170 for sure.
And I got placed my puts at 180 and 175, so I'm still in the loss on it. And guess what? I hope to buy more. I have a pretty decent position right now. I have about 1.25% of my money of my cash in Alibaba, and I want to make it 3%. So I have to sit there, and I hope it stays down. And I look at it going, okay, this is my analysis is that I see all Chinese stocks being hit because everybody's concerned about taxes and delisting. I think that's an over-exaggerated concern. So I'm going to keep buying some. And guess what? It'll probably go down further from here, and I'm okay with that, right? I'm fully okay with it going down because if I believe in the company, the one area I've copied Charlie Munger, his belief in Alibaba's numbers, I'm cool with it. Now, did I come up with my own value? I have no idea what Charlie Munger values Alibaba at. I don't care what Charlie Munger values Alibaba at. But that comes with 20 years of me experiencing and being independent. And the first time was, I remember in 2004 in real estate, somebody telling me, why aren't you buying in Arizona? I go, it just doesn't, the numbers don't make sense. I'd rather buy in Ohio. But Paul, it's growing. And that was the first time I was like, yeah, you're right. Maybe I'm wrong on this one. Luckily, I was too lazy to go to Arizona and buy real estate because it fell well below 04 values in 07 and 08. That's just the way I view the world. Does that mean there isn't a way to make money off momentum? Guys, I love momentum. We're going to be making, but there's a process to momentum. And I'm going to be creating that process based on the Turtle Trader book. And the problem with most hype people is they don't have a process. So they don't know when to get in and out. They don't know when to get in and out. And funny thing is, in the Turtle Trader book, the funny thing they always say is, they don't really care when you get in, as long as you're around there. But when you get out is the most important part. Have your, boop, this has happened, I'm out. We don't have that with value. It's very easy. Value investing is, this is my value. Great. If it hits that value, I'm out. Or you could be a long-term buyer and say, you know what? I bought Amazon. It's a great company, high return on invested capital, very sticky. I'm going to keep it even if it goes overpriced. Great, more power to you. So your exit strategy is never. I'm fine with that. I once got criticized by a big corporate guy saying, how can you want to own real estate forever? You have to have an exit strategy. No, I don't. I don't have that exit strategy. I want to own it forever.
Yeah.
Fine with that.
I'm asking you how to develop sort of this thicker skin that you have to absorb some of this criticism.
Takes time.
You know, my wife, a very just a simple gal, like most of our viewers, a normal person, said, you know, why do the hype YouTubers do so well? Why do they get so many clicks? Why does the clicks and subscribers transition into people thinking that they know more than us and vice versa? But the point is, I said, you know, Beth, you're a new investor. You're watching a YouTube and you finally jump on the train and someone says a stock, you know, Tattooed Chef, or because someone like Jeremy has 600, 700,000 subscribers, you type in stocks and maybe Tattooed Chef pops up. And there's two videos, Paul, and one says, Tattooed Chef is amazing. You should buy it. And another one that stars Paul Gabriel says, be cautious. I'm not into this stock. Which one are you going to love and watch?
Not only that, what makes more sense? This company is a great company. They have a lot of potential. Buy the stock. Or this company is a great company, has a lot of potential, but don't buy the stock. Which one makes more sense?
Yeah, it just feels more fun.
It makes way more sense to do the first one. Yeah. I get it. I used to be the same way.
Yes.
I used to believe, well, if the company is growing fast, it's okay for me to pay. No. Then I started to realize that you can overpay for growth.
Well, and you went through some things. You overpaid for houses.
Mm-hmm.
Mo has not followed rules and lost 27 grand in one transaction. I mean, I guess some of these folks, as you said in our Meet Kevin reaction video,
you need to lose money.
You just need to lose money at some point. You know, if you have children out there, I do this all the time, Paul. There's a hot stove and plates, and at some point you can stop them from touching the hot stove. And then at some point in my mind, I was like, you know what? If he just burns his hands once, he's probably not going to touch a hot stove again. It's like you can only protect these people so long before. So I think.
So let's talk about that for a second, Seth.
Go ahead.
Let's say you're 25 years old, okay, and you're going to invest $10,000 a year, okay, and you're going to retire at 70. Let's say the first year you buy 100% hype stocks and this 10,000 goes to zero. How much does that hurt? A lot, right?
Keep going with this.
But what if that going to zero changes your way of thinking?
Oh my gosh.
And you go from 10% returns to 12%. What's the difference in net worth?
Oh my God.
Let's do that.
Oh my God.
What's the difference? So now instead of, let's say you invested $10,000 a year at 10% for 45 years.
And let's be very clear, folks. The reason we're so adamant about this is the number one response we get when people finally find our channel is I got burned by Stock Mo, Meet Kevin. I got burned by cryptocurrencies. And now that I got burned, I'm ready to listen to Daddy Paul, Uncle Paul, and creepy Uncle Paul.
So if you do the $10,000 a year for 45 years, you have $7.2 million making 10% a year. That's great. But let's say you get burned so bad you lose all your money at the age of 25. So at the age of 26, you go, I'm going to learn. And now you do 12% a year for the next 44 years at 10% a year. Sorry, 12% a year. You now have
12.1 mil?
12.1 million. That $10,000 loss might have made you $5 million bucks. And that's what I'm doing.
I think
so when my friends tell me, like, Paul, you're trying to time the market, I'm like, I'm not trying to time the market. I'm just trying to buy when it's smart. And buying when it's smart and not buying the hype will save me the money where, yes, today I have less money, but when I'm worth $5, $10, $15 billion, am I going to care about the extra $5 million I could have made by being in the market? No. It's irrelevant. It's a drop in the bucket. That's why the process matters. The right process, learning the hard way, makes you $5 million more than that stupid $10,000 you lost early on.
But I don't think people will ever know. They're going to love 7.2 million.
But you know why? They're not going to even get 7.2 because you're going to hire a financial planner. He's going to get you 4 million. And you're going to brag to your friends. Look, I gave him 10,000 a year. He gave me 4 million bucks. That is shit. That is shit. You would have been better off buying the ETF. Mm-hmm. That's why you're wasting your time and money. But if you just learn the lessons, take 2 years, take 3 years, take 4 years, learn the Tim, would you please stop that? 4 years, take the 4 years, stop doing it, and guess what? You'll still have millions and millions of dollars more, and that's what we're trying to teach you. And guess what? You're learning it for free right here.
Paul, I think another thing my wife brought up, I just love getting feedback from just normal folks in the world who aren't super investors and are still trying to learn.
What's a normal folk, by the way?
I mean, as someone who literally goes on YouTube and watches a couple of videos and think that's due diligence or that's what they should be doing. I mean, it's a dangerous platform for new investors. But she said, Paul, we did a Baba video and you casually wrote 200 grand in puts on Baba last week. But my wife says, if I buy a couple shares of Tattooed Chef at $14 or $16 and it goes to zero. Well, I'm out a couple bucks. No big deal. Why don't I take a risk? Why don't I gamble on it?
And I'm okay with that.
And I've asked you this in the past. Why would someone with so much money who could literally buy anything you ever wanted, and I've seen you buy things, you are not what the world portrays rich people as. You are very conservative. You go to McDonald's when I want to go get a steak.
I had McDonald's this morning.
You did, of course you did. You could have anything you want, but why would someone with so much money still be so stringent and disciplined, whereas normal lay folks are still, buying cigs, lotto tickets, and chancing it on Bitcoin and hype stocks?
Yeah, so that a lot goes into, what's the mentality of, the book Millionaire Next Door. Did you ever read that book?
I have read it.
Oh, it's a great book. It was the first book I read on personal finance. But I will say...
Me too, probably.
Is it really?
My apologies, a retired person who was over my age that was one of the first books I read when I got into this, yes.
Now, I will say, I do think the rich person portrayed in that book is more of the... I think it's a little more... conservative than even I live. Like, I live a conservative life relative to my income and wealth, but at the same point, I look at it going, it's okay. Like, Warren Buffett goes to this extreme of the guy makes billions and billions of dollars and he won't, buy a new car. To me, that's a little bit of an extreme. But if that's his thing, that's his thing. I don't criticize that. What I criticize is this lifestyle of I remember senior year of high school, we had career day. You're going to like this. We had career day, and a guy came in and bragged about making $100,000 a year back in 1999. And I raised my hand and I go, "Hey, how much do you save a year?" He goes, $5,000. And he bragged to me. He goes, "Yeah, but the lifestyle I live, all my friends think I make $250,000, $300,000 a year." That was his bragging. Like, he was bragging about that. And I remember being like, wait, you only save $5,000 out of 100 and you brag because all your friends think you make 250, 300 because your lifestyle? I'm like, that didn't make sense to me. The other way around though is if you make 100 grand a year, I mean, I don't know. I just look at it going, there's a happy way to live life, right? I just choose that my investments are very important. I like making investments. So I was born with this like innate desire to make investments, right? And that's why I look at it going, if you go fiddle, I'm okay with, hey, go take a shot on some stocks, but don't make that 80% of your portfolio. Make it 5% of your portfolio.
Yeah.
And have a system in place for it. And by the way, the book club is still on, David. There's a chat in Discord for book club. You didn't want me to say that?
No, I was saying, yeah.
Oh, good.
I think this is Ross Ham saying Manesh Pabrai doesn't talk about value investing to make lots of money, which he has. He sticks to a process to win the game. It's funny, I just thought the other day, I've changed my shift from what's my net worth to what returns am I getting on a deal, right? Because if I focus only on net worth, then I'm going to start chasing returns as opposed to focusing on, listen, did I deploy this capital into a good asset that made me 15 or whatever the number ends up being? If I focus on that, yes,
that's all that matters.
You win, yeah.
The results will end itself. Now, do I admit that obviously I can afford to do that, but even you can too? Because your thought should be in dollar cost averaging with an ETF is every month you invest, you are saving for your future. If you look at 30 or 40 years from now, you will have more money 30 or 40 years from now than today, probably a lot more. And if you don't worry about the emotions of things, it's the same mentality I have. It's just different numbers. That's all you should worry about is the process. If you do the process correctly, it'll end up working out very, very well in the long run. You will look stupid all along the way because when stocks are up, well, no, if you do the dollar cost averaging, you'll be fine. You'll always be buying, right?
Yeah. Something I was going to pull your attention. David.
Oh, Tim, you got a mic right there, actually.
Why are we still buying stocks?
Mike, grab that mic, Tim. Actually, we can hear you if you want to grab it real quick.
What was the question, Tim?
David,
Yeah?
I hope I'm saying your name right. Says, if we were expecting a crash, why are we still buying stocks? So David might be new to the channel.
Okay, great question.
Well, we brought this up yes, that's right, Paul. We brought up some stock market correction or crash videos where we talk about, the next decade looks fairly dismal. And so this is a should we wait or?
The top 7 stocks in the S&P make up 25% of the S&P value. These will drive stocks down a lot. Second, when stocks are down a lot, when overhyped stocks and bubble stocks are down a lot, value tends to do better. There are many, many value investors, if you read Rich Wiser Happier, well, they'll say from 2000 to 2002, they made money in those years. So I'm buying stocks that I think will be attractive when all of a sudden hype loses its luster. People are going to go to, okay, what's the good metric for cash flow? Great, I can buy this cash flow very cheap, I'll buy it. That's what's going to end up happening, right? That's what always ends up happening. That's why we're still buying stocks, but that's why I'm being very selective. That's why I only have 6 or 7 companies in my portfolio, because I'm hoping, my goal is that even if I lose money, I don't lose as much money. And I have the benefit.
That's a concept people don't quite understand,
I know.
Why I'm in the little book stocks. And, people say, well, if it goes down, it might go down during when the market's up, little books might be down. And I guess the point is I try to tell them.
Well, they won't be down, but they might not be up as much.
That's right. Like when the world is losing 13%, I hope to maybe only lose 5%, and thus a win, Like
by the way, that's a very important thing in value investing. They always say it's about your downside risk. To draw a baseball analogy, I really hope a lot of people here know baseball. Are you more likely to succeed getting on first and never hitting home runs, or
swinging for the fences?
Swinging for the fences all the time, striking out 95% of the time, but 1 in every 20 you hit a home run.
But guess what, Paul?
What?
Some of the most famous baseball players that ever lived always swung for the fences.
Who? Babe Ruth is the only one I know of. The highest OBP is Barry Bonds. The highest OBP in history is Barry Bonds.
Come on.
I'm pretty sure. There were years where he got a.
I'm just saying, like, hype stocks is that chicks dig the long ball.
And guess what? Amazon was a hype stock. But what we don't remember is Amazon went from 113 down to 6 before it became the big hype stock. Mm-hmm. That's one of the few that I can sit there. Intel was a hype stock. It still hasn't surpassed its 2000 high.
Same with
Cisco was a hype stock. Still hasn't surpassed. It's all about, same with real estate. A friend of mine bought a house in Miami in 2006 for $450,000. $450,000.
Had to go up.
In Miami, Florida. What's the population growth in Miami, Florida since 2006? Probably 15 or 20% growth. Guess what? They're now selling it in one of the most another overpriced market in history of real estate. They're now selling it for $375, and they're ecstatic.
$375 down.
$375. They're taking a $75,000 hit before paying commissions, and they're ecstatic. Who would have said to them in 2006? Everybody would have said, buy a growing market. I've heard billionaires say to me, buy in a growing market. Why? You can overpay. That's what happens. That's all I'm trying to sit there and advise.
Someone's actually saying, Ed was saying that Ted Williams is the on-base percentage leader for baseball. What a hitter he was, Paul. And
he was a hitter, but did he hit home runs?
No.
There you go.
That's the point.
That's the point.
I tell you what, too, it's really funny, Paul. This guy just said about Ted Williams, and folks, he's too old for most of you to know who the hell he is, but he's a great hitter and a crazy story when he died. But, Paul, I've watched hitting videos from him, and it's hilarious.
From Ted Williams?
I'm telling you, wait, let me bring this home. He studied his hits, thousands of them, and found, you're not going to believe this, that like he would set up 9 baseballs, like representing like high, low, in the middle. Yes, right. Okay.
There was this.
Yes.
And he'd be like, I need to hit them here, here, and here.
He would cross out all of those, all of the other ones, put X's in all the boxes.
Yep.
And said when the pitch came in there, like a stock, when the metrics add up, that's when he hits the ball. And all the other ones is an instant no, Paul. When he saw a pitch heading into those X boxes, it was a no for him. And this is batted.
And guess what?
Batted 300.
Sometimes
for his
he struck out because of that.
That's right.
But over long periods of time,
thank you.
He did very well. Couple good points. Barry Bonds did have a high OBP because of his home runs, but at the same point, it still all worked itself. He still got on base, and guess what? People were willing to pay him a ton of money even to not hit home runs. Why? Because he still got on base. Ted Williams had a lot of home runs, over 500. Great, but he wasn't the world leader in home runs. If you asked 100 baseball fans how many home runs did Ted Williams have, they're not going to remember. They're going to be like, I don't know.
Yeah.
If you told me 300 or 500, I believe both of them. I have no idea.
Listen to Ed must be a baseball. Listen to this, Paul. On base percentage was John McGraw. He's a big. Billy Hamilton and Oscar Charleston. I've never heard of those people. I've followed the game my whole life. So yeah, folks, if you want singles, remember that story I told you about Pete Rose? By the way, I'm going back to Las Vegas. I hate to change the subject. Remember I told you Pete Rose is just sitting in a sports card place at MGM Grand every day waiting to sign autographs by himself. It's so sad. Anyway, folks, yeah, that I can't believe you just brought up baseball because that Ted Williams thing really hits home for me, actually. So, all right, Paul, people are really talking. I guess, listen, folks, this is so much of a mindset channel because the idea of pressing buttons and buying stocks, that's the easy part. It's having the will, the discipline to be able to have thick skin to say, you know what, these 3 idiots, they're wrong. They're stupid. Follow me. And it's a tougher road, Paul, to just keep waiting till all this crashes down till our channel.
Let's pull up Bob as an example.
Okay, go ahead.
Let's look at the stock price right now. So right now it's up to 170. This is the 5-year chart. It's very, very easy to sit there here and go, this is a great stock. And it's very, very easy when it sits here to say it's a terrible stock. But if everything plays out to where I think it's going to play, I think this could very well be a $500 or $600 stock at some point here in the next 3 to 5 years. And if it is, the chart's going to look like, I just said the chart. The chart's going to look like this afterwards. And you know what? I'm going to look like a genius. I'm not saying because I am a genius. It's that wherewithal of saying, am I wrong here? Because guess what, guys? All along this way, I've been thinking to myself, am I wrong? Am I wrong? Am I wrong? Am I wrong? And I just keep going back to it going, I'm even reading. I'm like, the biggest things I see are the issues with China delisting, which I don't think they're going to do that to their largest company. And an extra tax rate, as people are talking about. I don't care about a tax rate. It's already lower than the US. I'm fine with that. 30%, fine. Charge them more. It's still going to be an incredible company in terms of financials.
People are even saying, Paul, as new investors, is the mindset would be, Baba's up. This is fantastic. But like you said, if you're buying this in terms of a long-term value play, you shouldn't care.
Exactly.
We criticize Stock Mo because he'll talk about buying ChargePoint for a long-term play. Then he pulls up the one-day chart and talks about what it's done since lunch. It's the exact opposite mindset you should have. Is more of a, if I'm buying this, it's a set it and forget it type mentality. Go ahead, Paul.
To go back to your analogy, and Edward in the chat brought this up. He's right. Warren Buffett talks about investing in stocks like you're at the plate and you have unlimited pitches.
That's
so imagine
true.
what would Ted Williams' batting average be if he was allowed as many pitches as he wanted?
And you're right, he couldn't strike out?
He could never strike out.
Oh my God, you're right. He would just
Or he could never walk. It's just
he would wait for his
next
bangers.
Next one. He would bat 800.
You've said this before.
That's what investing is. Warren Buffett says you should have an investing punch card. You're only allowed 20. That's what you should look at. You're only allowed 20 punches. The second you take one, you can never, ever, ever get that back. That's the way you should look at investing. But unfortunately, we all have idle hands are bad. Blah, blah, blah. We have this thing of like, if you're not active, I mean, I get teased all the time, like, oh, you're not active, you're trying to time the market. I'm not trying to time the market. I don't see the investments that garner my attention. I have stocks.
Selective. You're just incredibly
I'm just very selective. Real estate. I was literally buying houses sight unseen in 2009, just telling my guys, go to the house. If the basement has structural issues, we're not buying it. If it doesn't, we're buying it. That was my, it was so cheap, right? Tim, you've seen us.
Yeah, amazing.
As long as the structure's there, I'm fine. And that's where I look at it going, I picked the right time and then I went all in. That's what I do. I will be 100% stocks at some point in the next 3 to 5 years. When? I don't know, but I will be. But and then the difference I'll do probably in the future is I'll be a lot more, I don't know if I'm going to sell. If I like the company, I won't sell when it hits my price necessarily. And I'm going to always value it based on, hey, do I have other companies to replace it with? Do I have this to do with? I'm going to have options. So there's going to be income coming in. So I have to, as we do more real estate deals and we do other business deals, more money will be going in my stock account. So I have to worry about that. But for right now, I don't see the value there. So I'm not going to just force myself to buy something that I don't want.
Yeah, Paul, you're starting to get me. It's taken a long time. I've had a front row seat to you saying this for a long time. The fact that I buy BABA and when it goes down, I should be happy. And now that BABA's going up today, I'm sad. This is a weird concept, like I'm sad I didn't get more. Or is it, people might be thinking, or I'm thinking inside, is this the bottom? Did we already miss out on the bottom? But that's the idea of dollar cost averaging, which we have a video coming out this week about that topic, Paul. And
by the way, I think it is a record. 834 I just saw. I think it's a record. 837.
Well, we welcome you in from all over the world, of course, and you patrons, I love you with all my heart.
With all your heart?
Well, these patrons, Paul, I mean, Susie, Llewellyn, I could go on. I hate to start naming because I'll miss people, but their commitment to this channel, Paul, I mean, they're just here every damn day listening to us. I talk to Susie more than I talk to some of my dear friends in my life.
I think you told me before that you actually like Susie more than your wife. Is that true?
It's a close second. Beth is what I mean.
Susie, I almost came to London next week instead of going to Spain. We almost went to London, but I said at the last. I didn't want to deal with the London BS.
Well, while we're on that mindset, folks, let me tell you this. Our dear Susie, the Everything Money sugar mama, in her glorious British voice, which is so soothing, Paul.
Is she doing the book?
Oh, the book. She has read the first chapter aloud of Richer, Wiser, Happier about
Have you listened to it?
Oh, Paul, I've edited it down to a single video that we will be putting on our channel.
Video or audio?
Audio. You can listen to Susie read you Richer, Wiser,
How
Happier.
How awesome is it?
The first.
Can you play a little piece for us? By the way, guys, follow us on Instagram. Mo just texted me and said, remind everybody, follow us on Instagram.
I can absolutely play the piece for you, Paul. I'd have to cue it up here in a moment. But while I cue up Susie's new...
Ask Susie if it's okay for us to play it real quick.
I think it's... Say again, Paul?
Ask Susie if we can play it real quick.
Just, my mind just lost. Your mic just like seized up there.
What? Is it okay? Do you hear it now?
It's okay. Now it sounded like Voltron. It was all pixelated and graphic. Yeah, so Paul, while I cue this up, will you please talk about some of the software news that's coming out with the new 8 pillars with all four?
Guys, the new 8 pillars is awesome. Are awesome. We're going to release it September 1st. I think we should do it. What's September 1st? Wednesday or Thursday? Wednesday next week. We're going to release the 8 pillar, the new 8 pillars, guys. It involves a 5-year PE instead of a 1-year PE because we're looking at long term. It involves return on invested capital over a 5-year basis, not a 1-year basis. And it involves long-term debt. Can you pay, if you take the 5-year average free cash flow, can you pay off all long-term liabilities within 5 years? Some people want 3 years. I wanted to pick a more reasonable number, especially considering I'm using the 5-year average of free cash flow. So this is really exciting. I think it makes the 8 pillars awesome. I did some research last night on it. I think we have 39 stocks that fit all 8 pillars. If the dev is correct, if dev mode is correct, we have 36 stocks that fit all 8 pillars, which is great. Best Buy is one of them. Intel's one of them. It's incredible. We're really excited about it. We're also doing everythingmoney.com is going to be available for people to switch from Patreon. For the time being, and I will point this out when somebody tells me I didn't say this, for the time being, you'll be able to save your tax because we're not big enough to pay taxes in all states. Overseas, though.
I think if they want to do the switch.
Go ahead, Tim.
If you all want to do the switch in September from Patreon to everythingmoney.com, as far as your payments being processed, saving those money on taxes, not being billed twice if you're brand new.
Yep.
Guess what? Just email help@everythingmoney. Nick will put you on the list, and we'll make sure that as soon as it's available, we'll just email you and say, let's go.
Yep, so you'll save the tax money. It's going to be great. For the time being, you'll save the tax money temporarily. I don't know how long. There's some places you'll never have a tax. Like they're not even going to charge, it's not going to charge you tax ever because it depends on what state you're in. And some states charge software tax, some states do not. Some say you have to do X amount of business per year. Other states say it doesn't matter. Countries, forget those countries.
Forget about it.
Forget about it. So the software is going great, guys. Yeah, Canada has 11% tax.
Getting 11% tax right now.
And we're not gonna have to charge you that. So guys, the software is getting better every single. I actually have to pump the brakes. Tim, I'll be like, Tim, I want to do this. He's like, well, we don't have the devs for it. I'm like, hire a new one. I got to pump the brakes and provide more benefits in long term.
We're gonna go gangbusters.
I know.
So folks, let me be very clear: is we're not selling a course. This isn't a recorded video of Paul telling you the same thing he always says. There are no secrets. We're selling a data feed that you can get and have at your fingertips. Someone brought up yesterday we should analyze Lemonade. And within seconds, I fire up my phone, I fire up the Everything app, and look at the financials of Lemonade. That's all we're selling. There's no tips, tricks. It's just a data feed and some of the tools that we use to analyze said data. So, Paul, do you want to hear Susie here real quick?
So how do I hear it?
Here, just put these on real quick and see.
Okay.
Let's just see if I can hear it. Now, I'll give you a tease. Come this way to your right. Here we go, folks. This is Susie reading part 2 of.
How to turn
Part
$1
two?
million
I hear it.
Here, just put
into
these
$1
on.
billion.
Real quick.
Okay.
Okay, hold on a second. Here, look at this. Listen to this.
Either. Raised in modest circumstances in India, he knew nothing about investing, Wall Street, or high finance. Born in 1964,
It's awesome.
he spent the first
Put it on the
10 years of his
microphones.
life in
People can hear it
Bombay,
already.
Yeah, they
now
can hear it.
Mumbai.
So, folks,
Where-
that's it. That's Susie in her that British voice, reading you richer, wiser, happier. That'll be exclusive content for our patrons. So that's coming up very soon. Oh my God, Susie, thank you, Paul. I guess we've talked enough, right? Should we keep?
Get a request.
Oh, we did get a request. Okay, folks. I guess unlike a lot of other YouTubers, we do donations today. So if you want a stock request, it's a $50 donation to a charity. And my favorite charity, which is very near and dear to my heart, my friend started this nonprofit. It's in Akron, Ohio. It helps kids in STEM learning, science learning. And it's the Akron Children's Museum at akronkids.org. Mutual friends of ours, Paul, just said Akron needs this. And right downtown, they opened up a kids museum, and they've had hundreds of thousands of guests come from all over the states to this beautiful place, and they need funding. Go ahead, Tim, what were you saying?
They do send me thank you letters.
Oh, they send thank you letters?
Yeah, I didn't tell you guys, but I think we've gotten 3 of them.
Oh,
so
how
far.
nice.
They're really,
Yeah.
really
Oh, wow.
Which is
By the way,
pretty
check out JD.com stock.
Well, yes, that's funny, guys.
We just did a video yesterday on JD.com.
JD.com.
Did you see the stock?
Is it up 10% today?
Yeah, I know.
I looked at it before the show, but yeah, folks, this week we have videos coming out about JD.com. Obviously, we're going to talk about Pfizer. We talk about Boeing and their interest in Virgin Galactic's new merger. We talk about GM and their recall. Another video, and we update on CCL. It's been about 6 weeks since we talked about one of our fan favorites, CCL. We talk about McDonald's and the thumbnail. Tim, can you switch over to my screen? Yeah. Can you show them the thumbnail for McDonald's? Is it up? I mean, look how lit this thumbnail is, folks. And the boys were talking about, Paul, I do the thumbnails, and it really gives me about 7 to 10 minutes of being creative and artistic in this world. And look at you right
so
there.
Amazing.
And it's funny is that's not his hand. The hand is actually underneath Paul. That's just that's just a glove on Paul. So oddly enough, yeah. So anyway, that's. Yeah, so what else is coming out? We talk about Macy's. We talk about analyzing your margin of safety, dollar cost averaging into BABA. And obviously, we try not to be too clickbaity with our stock crash predictions. We're not predicting. What we're trying to do is just get you prepared with a mindset of when it goes down, be happy, be thrilled, and be buying. Go ahead, Tim. What are you saying?
So It's very, very long post, as Paul pointed out yesterday. But I've been updating the schedule since you all be going on vacation over the next week. We've recorded a lot of awesome stuff.
Yeah.
One of them, by the way, about stock market is how to buy stocks during a market crash. So that'll be coming out. I believe it's Thursday or Friday. So exciting.
All right. Richer, wiser, sexier, blunt game. You know I love you. I love you. You guys are awesome. Okay, folks. Paul, should we get after this? Marco is asking for Accenture. The ticker symbol is ACN. Did you happen to look that up? And you can clear that screen behind you, my dear friend.
I don't have ACN.
ACN.
Are you sure it's ACN?
No. XN. Marco, if you can help us. XN.
Oh, ACN. There it is. Sorry.
You got it? There it is. Okay, folks. Well, if you're new to the channel, we think fundamentals is looking at the past money and the company has made, and then and their shares and how much debt they have, and then using this past revenue as a model moving forward of what they can't do, and then we use our stock analyzer tool to predict what the stock should be.
Look at this chart.
And Paul, let's get after it.
This is the 10-year chart from $50 a share to $333. Wow. All right, so guys, $200 billion market cap, 5-year PE of 46. We want it under 22.5. That's an X. Decent profit margin, 1% dividend yield is $2 billion. Now, the good news is their 5-year average free cash flow is $6 billion, so they have plenty of money to pay their dividends. Look at last year's free cash flow stuff.
Now, Paul, let me stop you actually, because you haven't done any due diligence. I think we should shut the show down and research this company.
I'm obviously stupid because I didn't Google what I wanted to see.
That's right. Yeah, for the next 5 or 6 hours, we should watch YouTube shows about this company before we don't look at the numbers, Paul. I don't even care. We have to do our due diligence, Paul. You know this.
I know.
Should we keep going?
Let's go.
Okay.
5-year invested. Look at this 5-year return on invested capital. And by the way, it makes sense. Service-oriented businesses will have a very high return on invested capital because they don't require a lot of capital. So this is actually probably not a metric you want to focus on as much for a company like this.
In general, if you're joining us, Accenture is a leading global IT services firm that does consulting, strategy, technology, and operational services.
So it's like everything money. We're providing a service, right? We don't have to invest much money into equipment and building. So if we're going to have a very, very high return on invested capital, right? So it's a little misleading. As much as I love this metric, on a company like this, I'm not as like, yippee about it. Do you want me to do that again?
That was great.
Yippee!
Someone please meme that in the Patreon. Keep going, Paul.
All right. Revenue growth, 34 to 48. I don't know how much, I have to check. Do they do a lot of acquisitions, or will Accenture just grow naturally? I don't know. Net income, 3.58 billion to 5.78. Love it. Yeah. Shares outstanding. Okay, a little bit higher, 619 to 635. Over the last 10 years, they're still down, but they're up a little bit over the last, maybe they did an acquisition right here. Look at that. Paul, $20 million share jump. They probably did an acquisition somewhere.
I hate to stop you, but everyone else says that issuing more shares is awesome.
Great. Issuing more shares is great.
They just love it. I mean, I'm sorry. Paul, maybe I got to stop using everyone and everything, but like, we definitely hear some of the counter arguments to you is that issuing shares is just wonderful for this company. It gets more people involved. The market cap always goes up, Paul. In fact, except when it doesn't. And in fact, all businesses issue shares. So
except for Apple, Microsoft, Google. I mean, it's just, I don't get that. Like, I just look at, by the way, over time, all businesses at some point issue shares. Yes, because if they're overly expensive, you should issue shares instead of issuing debt. Let the suckers take your shares. The funny thing is, when a company issues shares because they're expensive, you're the sucker for buying it. They're just basically sitting there saying, wait a second, we could issue debt, but why should we issue debt when there's stupid people out there willing to overpay for our stock? We'll just give it to the stupid people. That's what they're saying to you, and you guys don't even get it. They're saying, you're stupid, take our stock.
Let's get after pillar number 6 for Accenture.
Look at this.
This is new pillar number 6, right, Paul?
$7.3 billion in long-term liabilities. Do you remember their free cash flow for the last 5 years? $6.2 billion. It's like 1.2 to 1. I mean, this is incredible. So that's a check mark there. 5-year free cash flow growth, 4.5 to 9.5, check mark. Now, guys, keep in mind, look at this big jump over these 2 years. I don't know why that is. We can look at it further. change in payables, and change in working capital. So I would stabilize this one. I'd probably go focus on this versus that 1 year. Just like if it was a 1 year big drop because of COVID, I wouldn't factor that in. But just for the heck of it, $6 billion times 20 is $120 billion. What's the market cap?
211, Paul.
211. That's an X.
Leave that up there for a second.
Sorry.
You always erase that because this is really the critical step, right, Paul?
Yes, you're right. And I do run through it a little too fast.
That's okay. So what we're doing, folks, is we're taking the free cash flow, the average, we're multiplying it by a multiple of 20. This is our starting point. And seeing what maybe the desired market cap. This is not the end all be all whether we're buying or not.
No, it's a starting point.
Starting point. So, you've come up with is it 120 billion you'd like to pay for this company in general? And the actual market price is 211, which
No, I'm not saying I'd pay 120 billion for it. What I'm saying is we need to start somewhere. And just like a 22.5 PE over 5 years doesn't mean it's the right number. Just like a 9% return on invested capital doesn't mean it's the right number. It's just a starting point. And you look at everything combined and say, okay, now initially I think to myself, this thing's selling for, let's go to the 8 pillars page. What is it selling for? It's selling for 34 times the 5-year average free cash flow. With the revenue growth that it is, I don't sit there and justify that. It's not growing like 20, 15, 20% a year. It's growing, what is the revenue growth? Let's go to the stock analyzer tool. It's about 5 to 7% a year. So why am I going to go pay some huge premium for mid-single digit, high single digit, on the best part, revenue growth? Yeah. I'm not going to.
So again, I'm not to bring up Jeremy too much. He got to this stage of stock analyzer and didn't quite. In fact, this is the second person who saw your low number and basically accused you of saying, well, that's what you think this stock is worth. And for Tattooed Chef, it was $5. For Palantir, it happened to be $2. But the point of this, folks, and no one's ever going to listen to this except that you watching, is what we're trying to say is we use this over the next 7 years. If you want a 15% return on something like Tattooed Chef or Palantir, you have to pay less money. But they always take your low number. So, for example, with Tattooed Chef, you said it was a $5 stock. Well, not necessarily. You said if you want 15% return with the numbers you're predicting, you have to pay that to get that return. You have to pay a lower amount to get a higher return. But he didn't quite grasp that, Paul. And so...
And by the way, it is a hard concept to understand.
Very hard. I still don't get it.
All the more reason why if you don't understand that concept, stop talking about investing. I literally, there was a money manager that I used to know. I still know them. And she couldn't understand how to calculate return on investment. She's a salesperson. Everybody perceives her to be attractive. She sells. If you don't understand how to calculate return on investment, if you don't understand how the more you pay for something, the less return you get, and vice versa, stop advising.
That's people. Never even discussed.
To me, that's like saying, folks. Hey, Seth, you're a wedding photographer. You don't have to put a lens on a camera. Then what are you doing?
That's true.
You don't have to put a lens on a camera. Like, get off the boat.
This has translated to like, Paul, again, it's just not exciting talking about paying less and making more money on an investment. I had a conversation with a buddy of mine, not a dear friend. He said he's gotten into real estate, Paul. And what do you think the first thing he told me about the first thing is, boy, I just love getting that money in every month. And I'm like, well, what did you pay for it? I mean, like, what are you paying for that money? It sounds like a great deal getting a bunch of money in, but if you're, this is the difference between revenue and profit.
And this is what people will say, like, oh, I'm making people will say, like, oh, this person get a great investment. They make $1 million a year. Well, did they invest $50 million to get it? $100 million to get it? Like, that's what matters.
I see. It's a tough concept, Paul. But anyway, let's get back to Accenture and what they're doing. What do you got over there?
So, guys, I put it in Stock Analyzer tool. And remember, my goal, for those of you who are going to watch this, take one clip out and go, oh, this guy's an idiot. My goal is to be conservative. Why? Because you should look at all investing as you're staring at the plate, just waiting. Wait for those pitches to come by. So I'm going to assume low assumptions. And if they hit the numbers, great. If they don't, I'm fine with that. Move on. Okay? So I assume 3, 4, and 5% revenue growth. I assume buybacks of 0, negative 0.25, and negative 0.5. Profit margin of 10, 10.5, and 11. Free cash flow margin, 13, 14, 15. And then PE. The PE is currently 46. I'm assuming 12, 14, and 16. Why? This is a huge company with not a lot of growth. As it gets bigger, it's going to be harder to grow. I get it, guys. You want to make a higher PE, and we'll do that in 2 seconds to show you how overpriced this company might be. Same thing with the free cash flow and returns, 15, 12.5, 10. Analyze, and I want you to ignore these numbers because we're still working on this data. But basically, guys, this is an overpriced stock. I have it low 100s. What's it at right now? 332. It's got to fall by 66%. Sounds like a lot. Well, it's actually selling for 45 times earnings. 1/3 of that would be 15.
Can you please tell our new viewers and people who've joined us from other channels why you only looked at the ticker price just now?
Because the ticker price just now is what tells me how they're dividing the company up in terms of shares. Because you are going to buy it on that. But at the end of the day, if they're issuing more and more shares, it's all about how they're dividing up the revenue and profit per share. And this is telling me, dividing the revenue and profit up per share in the future, I should pay somewhere in the low to mid 100s. That's it. Now, for those of you who think I'm being too conservative, okay, let's go 5.5, and 6% revenue growth. Let's do PE of 15, 18, and 20. Free cash flow, same thing. Analyze. Still overpriced. Still overpriced. We're still in the mid 100s. This is what you can use stock analyzer tool for. Go make your crazy assumptions. If you think this is a 40 PE stock going forward, I'd make the argument of, well, wait a second. Most people justify a high PE by saying it's growing a lot. This is growing 5% a year.
This is the
I grow 5% a month.
This is the frustration I have, and what you learning from you, Paul, about translating into what you should pay is just there's so many videos out there, and they just the key phrase is like anything under X amount of dollars is a great deal for some of these, these growth companies, these pre-revenue companies, and it's just like.
Well, they're not pre-revenue. Most of these companies do have some sort of revenue.
Not this one, but you're right. Go ahead. Well, some are pre-revenue.
Most of them have some sort of revenue. Okay. But either way, guys, it's just a process. And the reason I love the stock analyzer tool so much is it allows you to go change assumptions. What assumptions do you have to have to make the stock worth it? 10, 12, 15, and let's do a PE of 20, 22, 24.
Yeah, so Paul, here's someone, Nature Boy, welcome in. He said it's overpriced per, quote, your calculator. Nature Boy, I love it. What is your calculator? We're trying to give normal people something besides hearsay when investing in stocks. Investing is not a hearsay, what if. Paul, I had this conversation.
Every investment is the present value of all future cash flow.
That's a confusing statement. Please dumb it down for me. I'm serious.
Guys, if I were to tell you an investment was going to generate this for the next 5 years, and then go to zero,
$15,
$15, what would you pay me for it? That's all I'm saying. What I'm sitting there saying is most people today are paying this, and I'm sitting there saying, why would I pay $20 to get 15? Because all you sit there and see is a stock price going like this. You don't look at the cash flows. But over long periods of time, every business will follow its cash flow and earnings. As long as everything else, as long as they're not issuing too many shares, et cetera. But the fundamentals will drive the business. The things that matter the most are they diluting you, and are they increasing their free cash flow and their earnings? If the answer is no to dilution and free cash flow increasing, the stock will go up as long as you pay a reasonable price for it today. Every investment is based on what you're going to get in the future. And that thing in the future could be the stock price at the end of the day too. But if you overpay for it, you're screwed. By the way, I saw 866 live, guys. Thanks very much. That's another record. Guys, everything is a present value of all future cash flows. Everything you buy is and by the way, if you don't believe that, please do me a favor. Write me a check for every dollar you have. I'll give you a 2% return guaranteed the rest of your life. 100% will guarantee that. I will personally sign for it because that's all you care about doing is getting 2% return when you overpay for stocks. Right now, if you buy the I shouldn't even get into that because I still think you should buy the S&P if you're saving for the future.
We should not digress, Paul. We have tons of donations. Donations are going.
Well, we're only supposed to have 5.
We have 4 more.
Okay, let's go. What's the next one?
By the way, I feel much frothier in the morning, Paul. I mean, this is a nice time. It is. It's nice. Okay. We appreciate the donations. They're going to Akron Children's Museum.
I totally forgot about what's the next stock.
I got it, baby. Ed is looking for KLIC. What is KLIC?
Kulicke and Soffa Industries. Soffa.
KLIC.
United States-based company that's principally engaged in designing, manufacturing, and selling capital equipment and expendable tools.
There you go, baby.
That are used for assembling some semiconductor devices. So they're probably surging right now because of Intel and those guys. All right, $4 billion market cap, 5-year PE of 41. That's an X. Healthy profit margin, adorable dividend they can easily afford.
Yeah.
And a 5-year return on invested capital of 10%. Check mark there.
You like that.
So we have one X and one check. And by the way, this is a business with a lot of probably capital requirements and good return on invested capital. So that's good.
Revenue growth is pillar number 3, Paul.
Wow. 739
Check, please.
to 1.2 billion.
Very nice.
Now, the question I ask, did the chip shortage help this? Is this going to be a long-term gain? They literally look at this over doubling of revenue. Look at the last 12 years.
Down.
Take out last year, it's down. I'm not saying it's not good. I'm just sitting there saying you have to understand this as part of your due diligence going forward. This is the thing, guys. If you just do due diligence now and read the news, you'd be like, oh, this is a great stock. I'm looking at it going, yeah, this concerns me.
Hated it.
It took a major chip shortage for the revenue to go up. I don't know if I like that. Is that sustainable? I don't know. Maybe it is.
Mm-hmm.
Net income. Look at this. 96 million to 250. Is that sustainable?
Oh boy. Look at the year before.
Look at the year before. Yeah.
Down, 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 down.
So I'm automatically right now thinking to myself, hey, good thing I didn't do due diligence. So good thing I wasn't stupid to say, let me go look at the news and the articles to decide if I like it or not and all the hype that's around it. I looked at the financials first and said, okay, something's not making sense here. But good thing I'm stupid. Mm-hmm. 71 down to 62. Good.
Buying back shares?
Buying back shares, which is, by the way, also bad.
Unfortunately, they're buying back shares. Yeah.
All right, balance sheet. Mm-hmm. Total long-term liabilities are 128 million. Oh my God. Total current assets of 1.18 billion and total liabilities of 436. That's $700 million in extra money.
Wow. The market cap is $4 billion.
So it's okay. Okay, so what was the 128 million in long-term liabilities, an average of 98 million in free cash flow. So they can pay it off in a little over a year. That's great. Look at this. It's more consistent on the free cash flow front.
That's weird. Not a huge
A little
jump.
bit more consistent.
So the average free cash flow is about 100 mil?
About 100 million.
Times 20?
Yeah, it's $2 billion.
And the market cap is $4 billion, but they have some money on the books.
Yeah, so call it $3 billion. It's still too high. It's still high. 30 times.
And I think the ticker again, it doesn't matter what it costs at the moment, but the ticker trend is sort of showing that, at the moment it's a little extrapolated and a little parabolic. And so
the thing I would do here, Seth, I'm not even putting in a stock analyzer tool, and here's why. You really need to go figure out if their revenue is sustainable. So they go from 585 million 2 years in a row to 1.2 billion because of a chip shortage. I don't think it's a sustainable revenue number. That's just not sustainable, right?
Yeah.
I think it's remember guys, looking at investments, if you only bought a company based on their last year's profit, it's just same with real estate. When we buy a piece of real estate, we say, give us 3 to 5 years. Whenever I look at any business, give me 5 years. I don't want to see how you did only in the one good year where you were like, oh, we're going to sell next year. Let's go make everything really, really rosy. No, I don't know. This one is off 1 year of rosy assumptions based on a semiconductor shortage. Next stock.
Ahmed says hello from Dubai. Paul, he says he's been watching since we had 2,000 subscribers.
Wow,
Thanks
that was November.
Yeah. Okay, Anthony is asking for us to look at the historical PE of Monster Beverage, MNST.
Who's Anthony?
Now, Paul,
drummer.
I've had some blue monsters flowing through my veins
Hang on a
through
second.
the
What's
2000s.
that from?
I don't know. I didn't see it.
Wayne's World.
Oh, really?
Who's Anthony? My drummer.
I can't remember. Yes, lots of Monster has flown has gone through this, and I stopped drinking this stuff. But let's look at the company.
Compare. Why are you asking about historical PE? Don't look at historical PE to say if a company is cheap or expensive. That's like the example before where I say, okay, I'm going to ask $20 million for my house. I see it keep it on the market for 5 years, and in year 6 I go, fine, I'll ask $10 million. People go, oh my God, it's a screaming deal. Guess what? The house is worth whatever, $1. Is it a screaming deal anymore? No, it's still not a screaming deal. Don't look at historical valuations as an industry whole. You might look at that, but even then, it still comes back to the fundamentals of, are they able to increase cash flow and earnings at a higher rate than other industries? Then you'll pay a higher multiple for them. That's it.
What's the market cap of Monster, baby?
$51 billion.
Jeez, a waste.
5-year PE of 47. Healthy profit margin of 30%. Return on invested capital, not surprising, 18%. These businesses, soda businesses, tend to have very high returns on invested capital. No dividend. But I like this. The 5-year average free cash flow is about $1 billion, and last year's $1.26 billion. So more consistent. Return on assets, 15.5%. Are we doing the entire analysis, or are we doing just the...
Do your thing, baby.
Revenue growth, yep, pretty consistent. Look at that. $3 billion to $5 billion. Profit growth, 765 to 1.5. Excellent.
Check,
great work.
please.
Shares outstanding, down 567 to 529. I like it so far.
Wow.
Except for the valuation. Total debt, $278 million. Oh, wow, look at this. Current assets, way higher than current total liabilities. That's good. So 278 million in total liability. Oh, yeah, they can pay off all their long-term debts in 3 months.
Yeah, so we're looking at our pillar
it's incredible.
Our new pillar number 6 is total long-term liabilities divided by their 5-year free cash flow average. And we want this under 5. Basically, you're determining if they can pay off all their debts over the course of 5 years, right, Paul?
Yep, exactly. Not even. So for this one, cash flow, free cash flow is 987. Look at this, guys. So 670, 857, a billion, $1 billion too. This is great. I love this. So this just seems like a company that's just too expensive. Monster, the big drinks are Red Bull, Monster.
Bang is one, I think.
I don't think it's nearly as big as those ones. Who owns Bang?
I don't know. I just see like Instagram people pushing it.
Celsius, things like that.
Go to the 8 pillars tab and let's see what you got there.
Oh, and by the way,
do you want to get?
But here's what we did deal though.
Yeah, let's do pillar number 8, market cap.
987. So 1 billion times 20 is 20 billion. That's an X.
It's 51 billion.
Yeah. So it needs to drop quite a bit. 8 pillars. Now this is gonna be a good one for stock analyzer tool though.
Really?
Yeah, because we're gonna sit here and say, hey, it's a fast-growing business with great fundamentals. Is it just expensive because?
Yeah. So typically, folks, when pillar number 1 and 8 are X's, it's just a valuation thing. So it's a healthy company in our opinion. It just is at the moment a little overpriced. Boy, they do a hell of a job on marketing, Paul. With the Monster, they put that M on every.
Racing, right?
Do the racing, yeah, and the BMXing and all that stuff. Listen to me, I'm like an old timer.
They're like the BMXing, those hoodlums with their BMX spikes.
These young whippersnappers today with their BMXing. Yeah. So Paul, what are you doing over there? Talk.
I'm doing my analysis. Let's see here.
Hey, Gary, Simon, I see you there. Alex, Matt, welcome everybody. LeChamp. Oh,
see, I just don't believe in giving these companies like huge multiples. But let's see how it goes. Analysis. I'm getting a price of.
Now we're in dev. We're instituting more changes into the stock analysis tool. That's why Paul's always crossing stuff out because it's new stuff we're developing.
Low 40s. It's currently at 96.
Oh boy.
But guess what? It makes sense. It's currently 46 times earnings. If it falls in half, but a faster growing company, okay. So maybe you look at it sub 50. Maybe you're paying attention at sub 50. Maybe when we have our watch list and alerts coming on the software, which will happen this year, you can sit there and say, hey, I like this company, but I need it under 50. So I'm going to put a tag here for under 50. Or maybe you put 60 because then you'll start, maybe the financials got better in the time it took to go to below 60. These are the things you'll be able to do with our software. What did Beaker say about my anal cyst?
No, he said it's this week's charity, Gary's Big Foundation.
Bigly. Paul, I wonder if we could do a live stream where I'm in the tub and you're next to me on the big board.
Oh, that'd be great.
Like Margot Robbie. And
Seth, that would be absolutely effing incredible. We need to get a tub in here. What's the next company?
Okay. Anthony, thank you so much for your donation to Akron Children's Hospital. And it's great.
It's not Akron Children's Hospital, Akron Children's Museum.
Oh, Akron Children's Museum, not the hospital.
Fuck the hospital.
Jody says, look at Roblox, Paul. RBLX. This is a new IPO. My kids are addicted to this.
We don't have 5 years of data.
Would you like to give Jody your thoughts on new IPOs and growing companies like this?
IPOs tend to not do well over long periods of time. It's losing money like crazy. It has revenue growth. That's huge. But, I always tell people, let everything go to the wayside. Just let it happen. And then once everything settles, the money you'll make on 1 or 2 IPOs will not make up for the ones you lose on the other 20 that sucked.
That doesn't sound fun though, Paul.
I know. Well, you want fun? Go get a dog.
Thank you, Jody, for your the wisdom you're getting from Paul.
I mean, I don't have to tell you, like, this is the way I view the world. I'm not saying this is the way I view the world. I'm viewing it from the standpoint of I look at history and say, most IPOs end up very, very bad because people do an IPO. I just heard somebody recently that I know is taking their company IPO in Europe. And the reason being wasn't a good reason. It was, well, those people are really hungry for what I have and I can get the best value and make the most money from it. Is that really what you want to be investing in? No. You want to invest in somebody who goes, like if we ever took Crossroads public, the only reason I ever do so is to say, hey, listen, I really think we can add value to a lot of people. I don't care about, I look at the Koch brothers. They own a $120 billion company and it's privately held completely. Why? Because they're like, we have plenty of money. We don't need liquidity. That's it.
Will you tell new people who are watching who you are and what your company does? What is Crossroads?
We have 8 or 9 businesses upstairs. We still haven't determined what the exact number is. It's kind of like this fun little thing. We have them all ranging from apartments to everything money. It's all over the board. We start businesses. We build them up. They're a lot of fun. They're great. I'm an investor. I allocate the capital. I used to be CEO. I stepped down so my brother could be CEO. Basically, he and my dad cornered me one day and said, "You're an idiot. Please step down."
You're a holding company. You invest. How many other investors do you in who? How many other investors invest with your company?
Oh, not anymore. We have one apartment fund that we have with like 20 people in it, but we're closing that down this year after our investment is sold, and we just like it's all privately held ourselves.
Now,
it's
you
all my
recently
brother and I,
scaled your real estate down from 1,000 to about 600, so you're sitting on a massive amount of cash, waiting for this to calm down.
I'm not waiting for a crash. I'm waiting for better times. That's it for me. I hate people when they go, "When's the crash coming?" I don't know or care. I just need better times. I don't care if no crash comes, but all valuations double. If all of a sudden, earnings all double and triple, I would be very happy. Great, now I can go buy. But what usually ends up happening is a very big drop in prices is what happens instead of the fundamentals getting better.
And then the following question is, if you're so wildly successful, then why are you doing this?
I love teaching. I teach at my high school for free. I'm going to be teaching at Case Western Reserve Law School for free. I just like teaching.
That's true.
Well, but if you want my time, you got to pay me for it.
I guess so.
I have a lot of people who message me and go, "Hey, can I meet with you?" I'm like, "No, I'm sorry." Because if I said yes to 1/10 of the people who asked to meet with me, I would never have time to do anything. I apologize. What was that? And then most wouldn't show up or take it seriously. And then I would hate you, and then you'd hate me. What's the next company?
Kaustube VJ only bid $5 to see Suncor Energy, but unfortunately, Paul, you don't do energy anyway. So we are donating this money to the Akron Children's Museums. We appreciate your support. Colin says he just gave $5 for my future on-air bubble bath show. We should just do that. It should be hilarious. So. And special thanks to Nick A. Nick A. Oh, that's right, Paul. You have that new tub.
Oh, yeah, I do.
We'll do the fireside in the tub.
But the windows are there. We would shut the window?
Oh, it'd be hilarious.
Okay. What's the next company?
There are none. Nick A. Said donating for the cause. The extra dollars for Paul to dance. So I guess on the way out, Paul will clear. We can just do a little number. I really want you to light it up here as we leave everyone with some of your dance moves, because I know you have a very Trumpish like swagger, and so
how does Trump dance? He goes like this?
Yeah, no, he does the back and forth, which you've done, right? But no legs. You can't do the
legs.
Oh,
you don't do legs?
No,
he's like this. Yeah. He's like a centaur.
And then lots of clapping, with like perfect.
Where's the Trump water bottle action?
Yeah, so going back to our Tim, if you show my screen, this is the video we're talking about, folks, about picking stocks and how to analyze. You see all the picture. Paul, can you see my screen over there to your right?
Oh, it's not on. Why the fuck's it on?
Yeah, so that's what we're talking about, folks. Is like we want the sweet spot when the chat enters the sweet spot in the bid and ask. That's when we want to buy, and when we ignore all of these videos on the outside about the chaos that is buying stock. So
I didn't see anything.
It's a tough road out there, but all right, folks. That is our take. Trapper, I love you. That's our take, guys. Someone said, M. Kruger said, how is this guy single? Well, he's neurotic, if you haven't noticed quite yet.
I think he's saying it's like, this guy is definitely single for many reasons.
All right, that's our take, folks. Tim, will you fire up some music so Paul can dance on the way out?
I got a haircut coming up here in 1 hour.
And we'll be on vacation. We still have videos coming out. And when this beat drops, Paul will really cut it loose.
Am I doing that, really?
Oh, just for a couple seconds. I mean, someone paid money for you they want to see the shorts. They want to see it all. You have to jump into the air. Any plans to go in Australia? No. Paul, again.
I want to go to Australia.
Stay tuned. We have a workshop in Austin in December. We'll get signups. Patrons have first whack at it.
I think it's going to be Patreon. Wow.
Smash the like, and Paul, dance. Go ahead. I love you. See you guys on your way out. Go ahead, Paul. Nice.
Oh, wait, what is it? Oh, I don't know how to do that one. What is that? That was terrible.